Okay. Okay, great. I have started the recording. Thank you everyone for coming today. 1031 exchanges are a really great opportunity for your investor clients. A lot of investors know about them, but what I've found has been really been a boost to my business is letting those people that just own one or two rental properties that maybe don't know about 1031, the opportunity of a 1031 exchange. And I tell them about it and they're super excited. So today we are very fortunate to have Shanae Mabry. Did I say your last name right?
Very close, Mabry.
Mabry. Okay, Shanae you can say it. She is the division manager at Asset Preservation Inc. She has over 15 years of real estate experience and 9 years experience directly with 1031 exchanges. And Shanae is one of only 107 people in the country to have the designation of certified exchange specialist. So we are super lucky to have her today, and she is going to let you know all about 1031 exchanges. Take it away.
Thank you, Heather. So I'm just going to do a quick screen share here so you can see what I see. So can you guys all see my screen just fine? Well, head nod. Okay, yes. Perfect. So just going to jump right on in here. So as Heather mentioned, Shanae Mabry. I always tell people when you think about my last name, think May like the month and Brie like the cheese, just without the Y. And there you have it. So Asset Preservation is a leading exchange qualified intermediary that has facilitated well over 200,000 exchange transactions over the 30 years that we've been in business. And then my direct experience, I very much like you all started as a real estate agent myself. So that's how I got my foot in the door with real estate and then transitioned into 1031 exchanges about 9 years ago and a local certified exchange specialist for you. And I looked up recently just because I was mildly curious, and I'm your only local certified exchange specialist in the North Bay area. So ta-da, you've got your local expert here. So happy to be a part of your team. So when you're working with clients who are selling investment property, there is a section of the tax code that's known as Section 1031, which allows for your clients or investors to sell their investment or business use property and defer having to pay their capital gains tax as long as they're reinvesting into other investment or business use property. And the great thing about this section of the tax code is that there's no one-time benefit. You can exchange for as long as you live for as many investment properties as you have under current tax law, which we'll touch on a little bit later in the presentation, but you can continue to defer the capital gains tax. And you can do that all the way through death. So instead of selling investment property, paying taxes and reinvesting the balance, a 1031 exchange is going to allow for you to reinvest all of that equity into other investment property and defer the taxes. So this applies to the sale and acquisition of investment or business use property. So of course, in order to accomplish an exchange, you have to use the services of a qualified intermediary, such as myself, to hold the funds in trust for your client's behalf. And so a qualified intermediary, we're a neutral-ish, we're a third party on your client's behalf that's going to receive in the proceeds from their sale directly from escrow. So we're going to assign ourselves into the purchase and sale agreement on the property that they're selling to act as a theoretical seller of that property. And we're going to transfer the ownership of that property to the ultimate buyer. And then when it's time for your clients to buy their replacement property, we're going to assign ourselves into the purchase and sale agreement, which is going to allow for us to fund their purchase of that property. And then it also allows for your clients to then deed directly into title on the property that they're buying. And so the main reason really that we get involved in the transaction is that the IRS doesn't allow for your clients to have constructive receipt or control over the funds. So that's why at closing, the title company will wire all of those proceeds of the sale directly to us to hold in trust for your client's behalf. So during the exchange period, they won't have direct access to use those funds for any kind of personal use. Now, I often get asked the question, well, how long do we actually have to own the property for it to qualify for an exchange? And the challenge is that there's really no bright line rule in the tax code that clearly sets out what the holding period is for a 1031 exchange. What's most important, however, is the intent of the taxpayer. And their intent has to be to acquire the property for investment purposes or for productive use in their trade or business. So when you look at time, time is just one factor, one component of the intent. Now, conservatively speaking, one perspective might be 24 months, and there's been some recent revenue procedures that have come out in the recent years that all point to a 2-year holding period, which is what most tax professionals will rely on for guidance. A more aggressive approach might be 1 year spanned over 2 tax periods. And the reason why a lot of people will say, well, at least 1 year is that if it's less than 12 months, then it's taxed at short-term capital gains tax. So anything over 12 months is treated as long-term capital gain, but it's really up to your client and their tax advisor to make that determination in terms of what they feel would be a safe timeline to qualify for the exchange. So a lot of taxpayers really have 2 options that they're facing when it comes to selling their investment property. They can either just sell that property outright and they're going to pay the taxes. But the challenge is that if they're wanting to maintain that same rate of, the return on their investment, it's unlikely that they're going to get that same rate because they've already paid a substantial amount of their net equity in taxes. So now you have less cash to reinvest, but hoping for that same rate of return. Unlikely. So the other option would be to 1031 exchange and defer all of the taxes and then reinvest that money into other investment property. And therefore, they're essentially just redeploying that equity that they otherwise would have given to the government in taxes and putting it back into real estate and making that money work for them. Now, when you look at gain on a property, it's really important to distinguish the difference between gain and profit, because profit is going to be the amount that they earn after expenses, whereas gain is actually the difference between their net sales price and their adjusted cost basis. And the adjusted cost basis is going to be what they paid for the property when they bought it. You're going to add to that amount any capital improvements that were made to the property over the course of ownership. And then you're going to deduct the depreciation that was taken. And so in this case, there's going to be 4 different levels of taxes that will be assessed. The first is going to be, didn't mean to switch screens on you there. So the first is going to be taxed at the highest rate, which is for the recapture of the depreciation taken, and that's taxed at 25%. Then once all depreciation is recaptured, it's going to then drop down to the federal gains tax rate, which is currently anywhere between 15 to 20%. And if they're over a certain threshold, once you apply that gain, there's also a 3.8, it's referred to as a Medicare tax or Obamacare tax or the net investment income tax. It's all the same, it's a 3.8 tax. And then there's also state tax, which we live in the lovely state of California, and state taxes can be upwards of 13.3%. So all in, if someone is selling in California, once you factor all of the taxes combined, on the low end, they could be paying 25%. And on the high end, they could be paying upwards of 42%. And just to quantify that, if you were to take $100,000 of gain, $25,000 to $42,000 is going straight to the government in taxes. So just to kind of put this into a real life scenario here, let's assume that you have a married couple. They file their taxes jointly and they are selling a property, and the net after deducting their closing costs and expenses is going to be $1 million. And they originally purchased a property for $400,000. They fully depreciated the property over the years at 75% of the property being depreciated. So now their capital gain is approximately $900,000. And the way that we determine that is we're taking, again, that $1 million net value minus, in this case, their basis of $100,000. And that delta is their taxable gain. So again, those 4 levels of tax will apply to the gain in this case. And so here we have, again, the original purchase price of $400,000. Their net sales price after deducting closing costs is $1 million. They fully depreciated the property, so they had $300,000 worth of depreciation taxed at 25%. So that's $75,000. They have the residual gain of $600,000, which is going to be taxed at 20% on the federal level. And then there's the 3.8 net investment income tax that is going to be assessed. So that's another $34,200. And then of course, there's also state tax. So on their $1 million of gain, or excuse me, net sales price, they're paying about $300 and call it $49,000 in taxes. That's a substantial loss of equity. And so again, you know, their net after deducting all the taxes that they're going to pay, they're left with $651,100. So they went from 1 million to 651. And thinking about that and putting it into perspective from an exchange standpoint, you know, assuming they're putting down 25% on a replacement property, well, that means that of that original million, their after tax net equity is only $651,100. That means that they can buy a maximum of $2,604,400 worth of replacement property. Whereas if they were to exchange, they had all of that million to reinvest into another property, they could buy upwards of $4 million worth of property. So you can see there's a substantial difference in the amount that they're able to now acquire through exchanging. So of course, there's going to be various reasons as to why someone might want to consider an exchange. And I think the first might just be to leverage their dollars and really make that money work for them rather than giving it to the government in taxes, putting it back into real estate. Now, they can also consider exchanging to diversify their portfolio. And diversification can really happen in several different ways. You know, one of the common ways that we'll see diversification happen might be geographically, but it could also be by property type. You know, I often hear, well, if I'm selling a single family home, do I have to buy another single family home? Or can I purchase a commercial building? Or can I purchase multiple properties? And you absolutely can through a 1031 exchange. So really, diversifying can occur by property type, by location. But another reason why someone might want to consider an exchange might also be to consolidate their assets. You know, perhaps they might have a substantial portfolio of smaller investment properties, and you know, they're tired of having to deal with maybe all of the various tenants that they have. So they can choose to sell multiple investment properties and pull those funds together to reinvest into one larger, more expensive property where it might make it a bit easier for them. You know, they might also want to consider exchanging because they can reinvest into something that's going to cash flow a bit better for them. Especially if you have clients who've owned investment properties for a substantial, you know, period of time, there's likely to be a substantial amount of equity that they're sitting on, and that money is really not working to their benefit. So by putting that money into a larger, more expensive property, it should cash flow if they're, you know, making the right investments. But they might also want to consider exchanging for management relief. Like I said, if they have multiple smaller investment properties, you know, they might get tired of having to deal with the day-to-day ongoings of being a landlord. So they might want to consider, you know, buying a larger, expensive property, having a professional management company dealing with that property. Or if they have property out of state, it can be quite a bit challenging trying to, you know, manage a toilet leak, or, you know, there's overflowing trash that happens, or plumbing issues that happens, or termites that happen. So it becomes quite a bit challenging trying to manage those aspects, you know, from a distance. But by exchanging, and if they're leveraging up in value, they can also increase their depreciation, which can be a tax benefit to them. And another reason why someone might want to consider exchanging might be for estate planning purposes. Now, under current tax law, you can exchange for as long as you live, for as many properties as you have, and defer those taxes. And when you pass away, your heirs will receive what's called a stepped up cost basis to market value. And what that simply means is that if your heirs sell the property close to the time of your passing, they don't owe back the taxes that you had previously deferred all those years through exchanging. So this can be a really great tool for wealth building and for wealth preservation. So when considering an exchange, there are some very key guidelines and requirements that your clients will want to follow. The first requirement for an exchange is that both the property being sold and the property being acquired must be held for investment purposes or for productive use in their trade or business. The second requirement is that they must use the services of a qualified intermediary, such as myself, to hold the funds in trust for them until they're ready to reinvest in their next replacement property. Now, it's important to understand that the 1031 exchange account has to be established prior to closing on the property being sold. It cannot be set up retroactively. And we can work quickly, but it's really important that they understand it must be set up prior to closing, because once they close on their sale, absent of our instructions, it's a taxable event. Even if they're closing on the replacement property the next day and using the same escrow officer, they still have to use the service of a qualified intermediary. Otherwise, they're deemed as having constructive control over the money and it's taxable. The next requirement is that they want to include a 1031 exchange cooperation clause in the contract, which simply states that they are informing the other party, in this case, the buyer of their property or the seller of the replacement property, of their intent to either sell or acquire the property through a 1031 exchange, with the other party agreeing to cooperate at no cost and at no liability to them. And their cooperation is merely them signing an acknowledgement form. It's the assignment agreement whereby your client is assigning us into the contract on their behalf. Your clients will enter into the agreement to exchange prior to closing on the property being sold. And once that closing occurs, that's when the timeline for the exchange begins, and they'll have to identify in writing to us the property or properties that they're intending to purchase. And they'll have to close on that identified property within 180 days from closing on the property sold. So when you consider an exchange and you're looking at, what's like kind and what qualifies for an exchange, again, it's going to be any kind of real property that's held for use in their trade or business. And any kind of real property qualifies, such as land, commercial, single-family homes, multifamily properties, industrial, office buildings, easements, air rights. These are more kind of unique replacement properties, but they all qualify for an exchange, as does a vacation rental. So if you think Airbnb or VRBO, those types of properties can qualify for an exchange. However, if it's a vacation rental for your client, which is very different from just a second home for them, because second homes, they go there as often as they want and enjoy it as frequently as they like without any regard to their use. Whereas a vacation rental qualifies. However, it's the IRS really evaluates the timeline and your personal use of the property. So for a vacation rental to qualify, they look at the 24-month period surrounding the time of the exchange, and they break it down into 2 different 12-month cycles. And during each 12-month period, they just want to see that the property is going to be rented for a minimum of 14 days or more, which is, pretty easy to accomplish. But they do restrict your personal use of the property to the greater of 14 days or 10% of your total rental period. So this means, let's say for each 12-month period for the first 2 years, you rent the property 100 days out of the year. Your maximum personal use could not exceed 14 days. Now, if you rent the property for 300 days out of the year, your maximum personal use would then be 30 days. So it's the greater of the two, the greater of 14 days or 10% of that total rental period. Once you get outside the 14 days, if you want to use it more frequently, you can. But if you want to have the ability to exchange in the future, you need to plan ahead again at least 2 years to make sure that your use falls within that use period. Now, when considering an exchange, of course, there's going to be types of properties that don't qualify for 1031 tax treatment. The first is going to be any kind of stock and trade or property held primarily for sale. So this is going to be very common if you have clients who are, flippers or developers, where they're just buying property, fixing it up and turning around and selling for profit, or the short-term hold properties. Those don't qualify for an exchange. Any kind of stocks, bonds, notes, the REITs, which are the real estate investment trusts, because with REITs, you're not acquiring direct ownership interest into real property. What you're acquiring are shares in an entity which owns real property, and those shares are personal property and therefore not exchangeable. Any other securities or evidences of indebtedness, as well as interest in partnerships, are not exchangeable. So let's say that perhaps we're the Better Homes and Gardens LLC, and I'm going, I kind of want to divest and just take my interest and exchange it. And maybe we own, the local Santa Rosa building together. Well, I individually, as Shanae Mabry, don't own direct interest into the building. What I have is an interest in Better Homes and Gardens LLC. So I have shares of an entity which owns real property, and those shares are not exchangeable. Now, if the LLC altogether wanted to exchange, it could, but the individual member of the LLC cannot exchange. Also, certificates of trust or beneficial interest, as well as any kind of personal use property, does not qualify for an exchange unless there was an investment component to that property. So for example, if you had a client who maybe had a duplex and they lived in one unit and rented out the other unit, well, the unit in which they rented could qualify for a 1031 exchange. Okay. So let's look at the actual process of the exchange. So you have the taxpayer in the middle, and that taxpayer owns their investment property, and they're going to enter into contract with the buyer to sell this property. The taxpayer is going to deed the property directly to the buyer. The buyer is going to deposit the money into escrow, who will ultimately wire those funds into the 1031 exchange trust account or the qualified intermediaries trust account. Once your client has found a replacement property, the qualified intermediary will fund that purchase into the escrow, or fund the monies into the escrow account, who will then release those funds to the seller, and the seller will deed the property directly to your client, the taxpayer. Now you'll see on the bottom of the screen here, I have a chart, a graph that shows the exchange period. And the first 45 days is really going to be the most critical to the success of your client's exchange, because that is the timeline that they have to identify in writing the property or properties that they intend to buy. And this 45-day clock is a hard and fast rule set by the IRS, and they don't allow for any extensions of this time frame or substitutions of properties once you go beyond the 45 days. So this 45 days is so critical, and it's important that your clients understand that 45-day clock when they're listing their property, because as you know, in this market, it's very difficult to find a replacement property. And they'll have 180 days from closing on their sale to complete the purchase of what was identified in that first 45-day period. Now, I often get asked, well, what happens if my client doesn't identify in the 45 days? Then they lose out on the benefit of an exchange, and it therefore becomes a taxable event for them. The same applies if they identify in the 45 days, and then, on day 46, they determine for whatever reason that they can't move forward in purchasing what was identified. They again lose out on the benefit of the exchange, and it's a taxable event. So there's no do-overs. They can't start the clock over. It's a taxable event for them. Now, there are 3 different rules that can be used to identify replacement property. The first rule, which is the most commonly used rule, is known as the 3-property rule. And this allows for your clients to identify a maximum of up to 3 replacement properties of any value. So with that, they can identify and purchase just 1 property or as many as 3. and they can close on any combination of what was identified. So if, for example, they identify 3, but they only want to close on 1, that's just fine. And we often will see clients identify multiple properties, even if they only intend to purchase one, in case the one that they're vying for doesn't pan out and they're still within that 45-day period, they have others listed as a backup. The second rule is known as the 200% rule. And this allows for the taxpayer to identify, in theory, 4 or more properties, but the aggregate value of what they identify can't exceed 200% of the value of what they sold. So for example, let's say you have a client that sells a property valued at $1 million. Using this 200% rule, they can identify 4 or more properties, but the combined values of what's identified can't exceed 2 million. And then the third rule is very rarely used. I've seen it used maybe 3 times now in the past 9 years. And it's known as the 95% exception. And it's really just an exception to the first 2 rules. And what it says is that you can identify any number of properties of any value, but you have to close on 95% of the total value of all properties identified, or the entire exchange would fail. So this means that they'd have to close on almost every property that they've identified, or their entire exchange would fail. So very high risk, very aggressive. Most commonly, your clients will utilize the 3 property rule, sometimes a 200% rule if they're really wanting to diversify their portfolio and acquire multiple properties of lesser value. But more often than not, especially in this market, they're going to consider the 3 property rule. Now, when you look at the exchange value, I often hear, well, don't I have to spend $1 more than what I sold, or the entire exchange fails? And I'm not quite sure where the dollar rule came from, but it doesn't exist. So in order for your clients to fully defer the capital gains tax, there's 2 requirements that they must meet. They must reinvest all of the exchange proceeds or net proceeds from their sale and apply it towards their replacement property. And they have to offset their debt obligations with either a new loan or new cash out of pocket. So here we have someone who sells a property for $900,000. They have about $60,000 in expenses to sell, which will include commissions, escrow fees, transfer tax, title insurance, etc. So those closing costs will come off the top. And then they have their existing debt of $300,000 being paid off at closing, which leaves them with net equity in the exchange of $540,000. So in order for them to fully defer the tax, they have to reinvest all $540,000 and apply it towards a down payment of the new property. And then they have to offset their debt of $300,000 with either a new loan or new cash. And with an exchange, you can buy up in value as much as you can afford. So here they sold at $900,000 and they're reinvesting into a property valued at $1.2 million. Their loan balance in this case is going to be $660,000, and then they're going to reinvest all of their equity of $540,000 and apply that towards a down payment. So in this example, there's no boot, there's no tax liability here because they've reinvested all equity and offset all of their debt. Now in the next example, we have what's called, boot. And they need to spend $900,000, but in this case, they buy a property valued at $700,000. So they're buying down in value, which again, you can absolutely do, but you're going to pay tax on the difference between what you needed to spend versus what you actually spent. So they need to spend $900,000, or they sell for $900,000, they buy a property at $700,000. On the property sold, they had debt of $300,000. And on the property purchase, they have debt of $260,000. So we can see they have to start $40,000 of mortgage boot. So they're paying tax on the $40,000 of debt that was not offset. They had closing costs of $60,000, which reduces their equity down to $540,000. And on the purchase, they reinvest $440,000 of their net equity. So they have $100,000 cash boot. So their total tax liability in this case is $140,000. So again, a 1031 exchange, it's not all or nothing. It's just if you buy down in value, you will pay tax on the difference. So let's talk a little bit about some of the trends that we're seeing, from an exchange standpoint in the real estate market, as well as President Biden's tax proposal and its impact on 1031 exchanges. So some of the common things that we're seeing in the marketplace right now, and you as agents see it firsthand, is that selling at a high price isn't an issue. Many of you are getting your properties listed and sold well above asking price, within a matter of days. But, that's not the hard part. The problem, however, is finding suitable replacement property. Inventory levels are incredibly low. So finding a replacement property within 45 days is really proving to be quite challenging for many investors. So, a practical suggestion, what I always encourage clients, start looking for a replacement property the day you know you're selling your investment property and wanting to structure that sale as a 1031 exchange. You need to start shopping because there's no extensions on that time frame to identify. So be proactive in your search for replacement property. And I think as agents, you have that ability to educate them at the outset. And once you do that, you're lining yourself up for another transaction with them, because now you're listing their property and you're also helping them find a replacement property. And these are going to be very motivated buyers because they don't want to pay taxes. So you're getting another deal out of the transaction by asking the right questions at the beginning when you take that listing. What are your plans after you sell? Have you thought about a 1031 exchange? And if you have, let's start looking for a replacement property. So because of the challenges in the market and the limited inventory levels, a lot of our investors are looking to fractional ownership interests like the Delaware Statutory Trust, where they might just have they might be one of 100 other investors who will acquire interest in a portfolio of properties. And another type of exchange that many investors are considering are reverse exchanges, where they want to buy the replacement property first before closing on their sale. And this takes away that stress of having to find property in the first 45 days of closing on their sale. But a reverse exchange really requires that you have clients who have the liquidity to be able to buy their replacement property without having had sold the property that they're intending to sell. So because of the market in the way that it is right now, there's a lot of activity happening. A lot of qualified intermediary companies are seeing transactional levels that we've never seen before. We're seeing record numbers on the exchange side, and many are seeing more than double in transactional volume than what they did last year. So a lot of exchange companies are having a difficult time keeping up with the activity levels. So because of this, we encourage you to talk to your clients about not waiting until the last minute to set up the exchange, because you want to make sure that the qualified intermediary has sufficient staff and the time to get the exchange documents in place with escrow. So to set up the exchange account, what we need is your client's contact information along with the contact information for the escrow officer handling the closing. We'll coordinate with escrow to obtain a copy of the purchase and sale agreement and the preliminary report. And from that, we'll extract out the sales price, the debt, equity, closing date, buyers, vesting, etc., to really educate your clients on what they'll need to do to be successful with their next exchange. So let's talk a little bit about whether or not I will have a job soon. So under President Biden's American Families Plan Act, what it includes is a $1.8 trillion, that's very difficult for me to say, $1.8 trillion of new spending, which includes obviously tax increases. And one of the ways in which they want to generate some of this revenue is by looking to 1031 exchanges. And this is something that comes up every election cycle for the past several presidents that we've had. It's not exclusive to any political party, whether it's Democrat or Republican, they all are seeking to attack 1031 exchanges in some form or fashion. It comes up every election cycle. But this time, what is currently being proposed is that they want to eliminate the deferral of exchanges for those taxpayers whose gain exceeds $500,000. which for many in California, you know, having gain of $500,000 is not unheard of, or, you know, it's not a far stretch, especially if you have clients who bought property in 2011 or 2012. You know, a lot of those properties have more than doubled in value. So having $500,000 in or more in gain is not unreasonable. So to eliminate the benefit of the exchanges for those investors would be substantial. They also want to provide an annual cap of $500,000 per year per person, or if they're married, it's $1 million of gain per married couple filing jointly. And the proposed effective date of this would be the end of December 2021. So the end of this year is when this would roll out. So any sale transactions occurring January 1 thereafter would be affected by this new plan. But the challenge and what we still don't know is, you know, can exchangers or can taxpayers obtain maybe a partial deferral? If their gain exceeds 500,000, can they just exchange up to 500,000? And, you know, do they pay tax on the balance? How does that work? So there's still a lot of questions that need to be answered, and there hasn't been anything written up in the Ways and Means Committee or the Senate. What we also know is that President Joe Biden is proposing almost doubling the capital gains tax for wealthy individuals whose earnings exceed $1 million or more, up to 39.6%. And so you might think, oh, $1 million of, you know, income, that's a lot. Well, that's also once you factor in gain. And I'm going to kind of jump down here really quickly. He's also proposing to eliminate the stepped-up cost basis on gains in excess of $1 million, or 2.5 million per couple with combined existing real estate exemptions. Now, remember I said earlier, 1031 exchanges under current law allows for your heirs to receive a stepped up cost basis to market value, meaning that your heirs don't have to pay back the taxes you had deferred all those years through exchanging. So you think about it, you know, if you have clients who've got, you know, farmland or properties that have been in the family for generations to come, they lose that stepped up cost basis. They're going to have to pay all of the capital gains tax back that had been deferred all those years by the prior owners. And going back, if it's doubled to 39.6%, imagine what that's going to do to their equity. And then the 3.8 net income investment tax would still remain for those who are making over 400,000, which now brings the tax rate up to 43.4%. And if this proposal passes, many investors nationally could see a combined tax rate for federal and state of over 50%. In California specifically, you know, capital gains taxes could be as high as 56.7%. Now, we do know that the primary residence exclusion has not been eliminated or adjusted in any way. So the primary residence exclusion of up to $500,000 would still apply. So your clients or you personally will not lose out on that benefit. So that's what we know in terms of what's happening on the exchange side. So just a little bit quickly here about asset preservation. You know, when your clients are looking for a qualified intermediary, it's really important that they're using a reputable company that has, you know, the experience and the expertise. You want to make sure that they're working with a company that has very knowledgeable staff that can be there to answer the questions for your clients during their transaction. Because as their real estate agents, this isn't your area of expertise. So you really want to entrust your clients to work with an exchange company that has a knowledgeable staff that can answer those questions. But you also want to make sure that they're working with a company that has strong financial stability and strength and protections in place for your clients' funds. So with that, I invite you all to contact me for any of your 1031 exchange questions or needs. I'm really happy to be a resource to you and to your clients. You'll have my contact information here on the screen. I'm available by cell, by bat signal, by email, however you need me. I'm happy to reach out. I often get asked a question of, you know, when we have a client and they just have questions, can we put them in touch with you? Absolutely. Whether it's, by phone, by email, by in-person consult, I'm happy to answer any questions that they have relating to the exchange process. So thank you.
Oh, great. Thank you so much, Shanae. I will tell all of you, Shanae, I have referred many clients to her and she takes absolutely wonderful care of them. And I'm often emailing her little questions of things that I don't know. And she's just a really great resource. So we do have a few minutes. Anybody have any questions that they would like to ask Shanae some more information?
I do.
Great.
It's Mari.
What's your question, Mari?
My question is, if you, I'm actually in a situation like this with a personal property. If I wanted to invest some of the money, but not all of the money, can I do that? Can I have the boot and just pay the taxes on the boot? Let's say I wanted, a couple $100,000 that I would just go ahead and pay taxes on, and then I'd have that money available. Is that possible?
Absolutely. So you can do what's referred to again as a partial exchange, where you're not getting the maximum benefit or the full benefit, but there's still some benefit that you're receiving. It's important to understand that in order to receive a benefit in exchanging, if you're going to buy down in value or keep some cash for personal use, you need to make sure that you're reinvesting above your cost basis. And again, the cost basis is, what you paid for the property plus improvements minus depreciation. So as long as you're buying above the basis, then you're benefiting from an exchange. But if you're buying at or below your basis, there's no taxes being deferred and there's no benefit in structuring an exchange.
Okay.
All right, thank you. I had something that came up recently. I'm currently have a listing right now. Oh no, we just closed on it, where there was two owners and one of them wanted to do an exchange and the other one just wanted cash out. And that was just fine.
Absolutely. So in this case, if you have clients, let's say that Heather and I own a property together, and we own it as tenants in common or, with 50-50 ownership or however the ownership split is, but we own it independent of one another. I can choose to cash out and pay taxes, whereas Heather can exchange her 50% interest. So all parties or all individual owners don't have to reinvest together. Some can choose to exchange and some can choose to cash out.
Thank you. All right, any other questions? Anyone have any specific situations they want to know about? Okay, sounds like you covered everything, Shanae. Thank you so much. Let's see that.
Oh, sorry,
Yeah.
I have one question. So if
problem.
I'm understanding this correctly, I have a friend who's looking to, well, she's with a partner who wants to buy property in the area. And she was thinking about possibly putting her own residence, renting it, but could she sell that property in exchange for, and do an exchange on that if she was going to be buying and replacing it with a rental property to rent out as like an investment?
So just to clarify, the property that she's selling now is her principal residence?
Right.
So if she's selling her principal residence, it wouldn't qualify for an exchange unless she moved out, rented it for a couple of years, and then decided to exchange out of it. But if it's just currently a primary residence, she'd be able to sell it. And if she's single, she would be able to shelter up to $250,000 of gain. Or if she were married, she could shelter up to $500,000. And then if there was gain in excess of that amount, she'd pay tax on it.
Okay. Okay, thank you. I'll
You're
email you
welcome.
personally to get a little more detail on that.
Perfect.
Great. Eric.
If you could you spend a minute talking about recapture depreciation and how it's calculated into the formula? Because I've
Sure.
kind of forgotten.
Yes, so I'm just going to pull up my screen here really. Actually, give me just a second. I closed out my window here. So one sec. Okay, and let's do a quick screen share. I'm going to just pull up the slideshow. Okay, can you guys see this?
Yes.
Okay, so again, when you look at adjusted basis, it's the original purchase price plus capital improvements minus depreciation.
Hmm.
And depreciation for residential properties is over the life of the property, which is 27.5 years. And if it's a commercial property, it's 39 years.
Hmm.
Most tax professionals, and again, I'm not a tax expert, will tell you generally about 75% of the property is going to be depreciable. And so you're going to take that, value, you take that purchase price times 75%, that's the amount that can be depreciated. So you're going to amortize that over 27.5 years.
Hmm.
And so going back to this married couple, here they purchased a property for $400,000. They depreciated 75% of the property. So $300,000 was depreciated, or they had taken depreciation. So every year on their tax return, they took depreciation. They were able to write off a certain amount of the property. And cumulatively, it came out to $300,000. So now when they go to sell that property, if they're just selling it outright without an exchange, they have to recapture it, which means that they have to pay back the taxes that they had taken, based on the depreciation schedule. And the interesting thing with depreciation is that I've had clients say, oh, well, because I didn't want to recapture it, I never took depreciation. And, the government is a little tricky here. Whether you take depreciation or not, they say that you had the ability to take it. So you still have to recapture it and pay tax on it. So take the depreciation. And so that depreciation is taxed at 25%. And then once all depreciation is recaptured, then the residual gain drops down to the federal gains tax rate level. Does that answer your question, Eric?
Yes, thank you.
You're welcome.
Great, thank you. And Norm has a question.
Yeah, my question is regarding to reverse exchanges, since that likely is the more plausible scenario for a lot of people. I know in the past, reverse exchanges were something that facilitators were a little leery of, because you essentially are taking, complete title to the property until such time as the buyer, the taxpayer, lines up and closes on the replacement property. So there's this ownership quantity or risk quantity. So at that, in the times I looked at in the past, there was a higher cost structure for reverse exchanges. And I'm questioning I came in a little bit late, so I didn't know whether or not you discussed cost structures for both a normal delayed exchange or reverse exchanges.
Sure. So in terms of the exchange fee schedule, what I will tell you is that we're not federally regulated. So a lot of it's different than escrow. Escrow has to post their fees to the insurance commissioner. So, their fees are going to be set. On the exchange side, you'll see fee schedules for exchange services kind of all over the board with different exchange accommodators. With asset preservation, we have very reasonable rates. I often refer to myself as a cheap date. So our fee for an exchange on a delayed exchange where they're selling first and buying second, it's going to be $1,250. So $1,250. This will cover their sale of one property and purchase of up to 3 replacement properties. For each additional property either sold or purchased in the exchange, it's going to be an additional $200. So if they sell 1 and buy 4, in this case, their fee for the exchange would be $1,450. On a reverse exchange, there's a lot more liability involved because we're going into the legal chain of title and coming out of title. It also requires that we create an LLC to hold title to that property on your client's behalf. So these are kind of more priced according to the transaction generally you're looking anywhere between $8,500 to $10,000 on a reverse exchange.
Which makes sense because basically your tax savings is going to pay for that anyway. So while it
Correct.
sounds like a big chunk of money in comparison to your tax hit for not doing it, or having
Right,
a
or if you
or
don't
having
identify.
a delayed exchange with a higher risk of failure given our inventory supply. I would think your reverse exchanges should be, going through the roof right now for people. So,
Yes.
I mean, so you're probably hella busy on this right now.
Absolutely. We just had a company call where they're asking for at least a 3-week lead time on reverse exchanges because of the volume is just unbelievable.
I have another
Is there
question.
any tricks that may want follow up on reverse? Is there there's no real tricks to help a buyer, I mean, they have to be, to buy something else, they basically just have to figure out a way to go out and purchase a property before selling the one they want to exchange. So that's
Right,
just a
so-
whole nother, there's no rules on how you do that. They just have to be,
That's a good
have
nightmare.
liquidity and the ability to borrow.
Exactly.
Thank you.
So I've got two more questions. This is
Yeah.
Mari. So if you identify 3 properties and before you get into the 45 days, one of them goes into escrow with somebody else or whatever,
Mhm.
another, can you add in another property because that one's been taken out?
As long as you're within the 45-day period, you have the ability to revoke and replace your identification notice to substitute properties as often as needed. On
Okay.
day 46, no changes, no substitutions, doesn't matter why it happened. Even if the property identified was a money pit or sold to another buyer or seller took it off the market, it's still going to result in a failed exchange for your client in a taxable event.
So is it best to be like pending on a property when you hit day 46?
Correct. I always encourage clients, if possible, you don't want to just identify in the 45 days. You want to try to have inspections completed with
Mhm.
contingencies removed. That
Mhm.
way, you know whether or not you're going to move forward in buying what was identified.
Good point. Another thing, what about triple net leases or something like that? Is that
Mhm.
a
Triple
way
net
to
lease
go?
properties work just fine. Delaware statutory trust works just fine. Any other type of direct real estate ownership
Mhm.
that for property that's going to be investment typically is a qualifying property for an exchange.
Okay, great. Thank you.
Shanae, there's,
Oh,
go
I was
ahead.
gonna say, I see there's a few questions here in the chat box.
That's
So,
what I was gonna say.
so a question came in from, am I pronouncing it? Is it Mock or Mac?
Mac.
Mac, sorry. It says when working a 1031 exchange transaction, is a third-party company such as your company required in the transaction? Yes, they are. Your clients are required to use the services of a qualified intermediary when selling investment property if they want to defer the taxes, because without us, your clients are deemed as having constructive receipt and control over the funds, and it therefore becomes a taxable event. So that's why there's the exchange agreement that will be entered into prior to closing, where we're assigning ourselves into the transaction. The buyer is notified of your client's intent to exchange. So it's very clear prior to closing that there was an intent to exchange.
I think you
There was-
mentioned that these were 1,200, right?
So it's $1,250, which will cover the sale of one and purchase of up to 3 properties.
Got it. Thank you.
Thanks.
Uh,
And there's
there was
one more
another-
chat.
Question, can a 1031 seller bring in a partner in the purchase property? Yes, they can. However, it can be challenging because when you buy a property with someone else who is not a part of the exchange, the IRS wants to see that the ratios of equity and debt are going to be equal and proportionate to one another. So this doesn't mean that you have to own the property 50-50. Let's say that you're going to own 60% and they're going to own 40%. That means that you're responsible for 60% of the equity or the down payment and 60% of the debt. The other party is therefore responsible for 40% of the down payment and 40% of the debt. It's not that you can come in with all of the equity and they're just going to, take out a loan for their portion. the IRS wants to see that they essentially have just as much skin in the game as you. And then
I
I
didn't
think
know that.
And then Eric has a question.
Yes, I do. In past years, I think it's been uncertain as to who we needed to report the upleg properties to within the 45 days. In other words, who was the official notice given to of our list of replacement properties?
So it's always encouraged, always identify to the qualified intermediary. And you can also identify to the seller of a replacement property. The challenge, however, is that the seller of your replacement property is not an exchange expert. They don't know what's required to properly identify the property. And when you're filing your taxes, I think it's form 8826, I believe is the form, don't quote me, but it's something to that nature, but it specifically will call for the date of identification and to whom that identification was made. And under audit, the IRS or the Franchise Tax Board, which is the state of California, will ask for evidence of a timely identification. Now, I doubt that the seller is going to provide you with confirmation that you timely identified that replacement property. And if you need to amend your identification notice and you identify to the seller, you also have to revoke that prior identification made to the seller, to them directly. So it's always a lot easier to identify directly to the qualified intermediary because they're going to be the party that's going to make sure that, you know, all T's are crossed and I's are dotted and that you actually identified properly using one of the three methods of identification. And it's also important to note that the identification must be made in writing and signed by all exchanging taxpayers. So even if it's a married couple, both partners or spouses must sign that identification naming that replacement property.
Okay, thanks.
You're welcome.
Great. All right. Well, thank you so much, Shanae. It is noon, so I think it's a good time for us to end this lovely educational opportunity. Thank you guys all for coming today. Hopefully you got Shanae's, all her great contact information. If you have any other questions, don't hesitate to reach out. She is really a wealth of information and very responsive and helpful. Otherwise, you guys all have a great rest of your week.
Thank you so much.
Yeah.
Thanks, Shanae.
Thank you.
That was excellent.
Thank you.
Take
You're
care.
amazing.